Hi, everybody, and welcome back to video number 3 in chapter 23. And when we left off, we were looking at segment disclosure. And here, if I review a little bit, investors and investment analysts want income statement, balance sheet, and cash flow information on the individual segments that compose the total income figure. So here, Comcast Corporation is doing just that. Here it breaks it down between cable networks, broadcast television, filmed entertainment, theme parks, etc. And then it breaks that down by revenue, adjusted EBITDA, that's earnings before interest, tax, and depreciation and amortization, and depreciation and amortization is then added to get to and capital expenditures and cash paid for intangible assets. Just the breakdown of capital expenditures, I think, is very helpful for investors that want to know where Comcast is putting seed money for the future. Okay. Arguments opposing segment reporting. Here, number one, without thorough knowledge of the business and an understanding of such important factors as the competitive environment and capital investment requirements, the investor may find the segmented information meaningless or may even draw improper conclusions about the reported earnings of the segments. Number two, additional disclosure may be helpful to competitors, labor unions, suppliers, and certain government regulatory agencies, and thus harm the reporting company. Number three, additional disclosure may discourage management from taking intelligent business risks because segments reporting losses or unsatisfactory earnings may cause stockholder dissatisfaction with management. Number four, the wide variation among companies in the choice of segments, cost allocation, and other accounting problems limits comparability and hence the usefulness of segmented information. Number five, the investor is investing in the company as a whole and not in the particular segments. And it should not matter how any single segment is performing if the overall performance is satisfactory. And finally, number six, certain technical problems, such as classification of segments and allocation of segment revenues and costs, especially common costs, are formidable. On the other hand, advocates of segmented disclosures offer the following reasons for support of the practice. Here, number one, investors need segmented information to make intelligent investment decisions regarding a diversified company. Alpha, sales and earnings of individual segments enable investors to evaluate the differences between segments in growth rate, risk, and profitability, as well as to forecast consolidated profits. And Bravo, segmented reports help investors evaluate the company's investment worth by disclosing the nature of a company's businesses and the relative size of the components. Number two, the absence of segmented reporting by a diversified company may put its unsegmented single product line competitors at a competitive disadvantage because the conglomerate may obscure information that its competitors must disclose. To provide information, so the objective of reporting segmented information is to provide information about the different types of business activities in which an enterprise engages and the different economic environments in which it operates. Meeting this objective will help users, alpha, better understand the enterprise's performance. Bravo, better assess its prospects for future cash flows. And Charlie, make more informed judgments about the enterprise as a whole. The basic principles that GAAP requires are that general purpose financial statements include selected information on a single basis of segmentation. A company can meet the segmented reporting objective by providing financial statements segmented based on how the company's operations are managed. We call that the management approach. An operating segment is a component of an enterprise that alpha engages in business activities from which it earns revenues and incurs expenses. Bravo, whose operating results are regularly reviewed by the company's chief operating decision maker. And Charlie, for which discrete financial information is available. So, our quantitative materiality test, it must satisfy one or more to determine whether the segment is significant enough to warrant actual disclosure. Number one, is its revenue 10% or more of the combined revenue of all the company's operating segments? Number two, the absolute amount of its profit or loss is 10% or more of the greater in absolute amount of alpha, the combined operating profit of all operating segments that did not incur a loss, or Bravo, the combined loss of all operating segments that did report a loss. And number three, its identifiable assets are 10% or more of the combined assets of all operating segments. Okay, in applying these tests, the company must consider two additional factors. One, segmented results must equal or exceed 75% of the combined sales to unaffiliated customers for the entire company. And number two, the FASB decided that 10 is a reasonable upper limit for the number of segments that a company must disclose. Okay, so if we step one, does the segment meet at least one of the 10% tests? If yes, it is a reportable segment. So we'll look at revenues. Sales to both external customers and inter-segment sales is 10% or more of the combined revenues of all operating segments. Profit or loss. The absolute amount of its profit or loss is 10% or more of the greater in absolute amount of alpha, here, the combined profit of all operating segments that did not incur a loss, or Bravo, the combined loss of all operating segments that did report a loss. And if we look at assets, the identifiable assets are 10% or more of the combined assets of all operating segments. So if they meet at least one of these tests, it's a reportable segment. Step two, do the reportable segments explain a significant portion of the company's business? The segmented results must equal at least 75% of the combined sales to unaffiliated customers for the entire company. Step three, are too many segments being reported? Reporting too many segments may overwhelm the users with detailed information. The FASB decided that 10 is a reasonable upper limit for the number of segments that a company must disclose. So let's look at an example here for the Watson Industries. They have identified the following 6 possible reporting segments in thousands of dollars. Here, their total revenues to unaffiliated customers. Here's their operating profits, and here are their identifiable assets. Which segments should be disclosed as reporting segments is the question. And Watson would apply the steps as follows. Which segments meet at least one of the 10% tests? And we find that Charlie, Delta, and Echo, we'll go back. Here's Charlie, Delta, and Echo. They meet the 10% test, right? And for revenues, for the operating profit, we're going to note that the 5% loss is ignored because the test is based on non-loss segments. So Alpha, Charlie, Delta, and Echo meet this test. So we have Alpha, Charlie, Delta, and Echo that meet that test for operating profit. And finally, identifiable assets. 10% times 970 total assets is 97. So Charlie, Delta, and Echo meet that test. Here we are, Charlie, Delta, Echo. So now step 2 would be that Alpha, Charlie, Delta, and Echo would be reporting segments, assuming that these 4 segments have enough sales to meet the 75% combined sales test. So step 2 then, we would do the reportable segments and see whether they meet the 75% test. So 75% of combined sales, 75% of 2,150, we'll go back here, here's 2,150, and we're going to take 75% of that, which is 1,612.5. The sales of Alpha, Charlie, Delta, and Echo total 2,000. That's 100, 700, 300, and 900. And therefore, the 75% test is met. Are there too many we'll take a look at step 3. Are there too many segments being reported? Watson is only reporting 4 segments, which is well below the maximum of 10 recommended by the FASB. So I think you can walk through this and see how we would determine reportable segments. So segment information to be reported. 1, general information about operating segments. 2, segment profit and loss and related information. 3, segment assets. 4, reconciliations. 5, information about products and services and geographical areas. And finally, major customers. And so if we take a review question real quickly here, which revenue of a segment is going to include what? Alpha, only sales to unaffiliated customers. Bravo, sales to unaffiliated customers and inter-segment sales. Charlie, sales to unaffiliated customers and interest revenue. And Delta, sales to unaffiliated customers and other revenues and gains. And the answer is, answer Bravo, sales to unaffiliated customers and inter-segment sales. That looks like a good place to stop this video. And when we return, we'll take a look at disaggregated information. Till that time, bye for now.